For more on CPI and the latest on the debt ceiling discussions, let's bring in National Economic Council Deputy Director Ramamurti from the White House today. Bharat, it's great to have you back. I guess let's tackle CPI first. They always say, wait until you see the whites of the eyes of inflation. Do you think we're getting anywhere near that point?
Well, we're clearly making progress and getting closer and closer each month. This is the 10th straight month on an annual basis where inflation has come down. It's down about 45% compared to last year. At the same time, we're continuing to see wage gains, so that over the last 10 months or so, real wages adjusted for inflation, are going up. And of course, over that time period, we've also gained millions of jobs. So overall, the economic picture is declining inflation, job growth continuing to go up, and wage growth continuing to go up, which I think is a really good picture.
Is there a sense there that shelter will be a consistent lag, and therefore we can count on maybe another print where it is the lowest month on month in a year?
Yeah, our estimates are that housing is going to continue to be a positive contributor to inflation. In other words, and continue to bring it down as that data continues to feed through into CPI. And I want to note one other important thing for a lot of folks out there. Food prices for the second straight month actually came down, which I know is a big relief for families at the grocery store.
So what do you expect at this point for the overall economy? We're getting signs that this is the high inflation, the rate shock, that it is weighing on the consumer. You see it in business confidence. Now we're starting to see it in consumer spending. The Bank of America credit card data, for instance, which has been super strong. Are you worried that the stimulative effect is finally wearing off and the consumer is making a turn here?
No, I think what we're seeing is what the president called for last year, which is a transition to steady and stable growth. Of course, we came off a period of time during the first year or year and a half of his administration where we were in a very rapid recovery, where we were gaining millions of jobs and we were seeing a huge increase in economic activity. That wasn't going to be sustainable for year after year. What we want is more steady, stable growth. I think we're seeing data consistent with that, whether it's on consumer spending, whether it's on business investment, and so on. Again, I think the picture we have is of an economy with declining inflation and steady, stable job growth, steady economic growth, which is exactly the kind of Goldilocks approach that we want to see.
What's going to happen with the debt ceiling? Is the president going to negotiate with the speaker in terms of spending cuts to get this deal done?
Well, look, it was a productive meeting yesterday. The president made clear that default should not be an option, and folks in the room agreed with that. Remember, we've never defaulted on our debt, and a default would be create a devastating economic crisis and immediately throw the economy into a recession. The president's also made clear, and he's made clear this for months now, that he's perfectly willing to have a conversation with Speaker McCarthy and other congressional leaders about tax policy, spending policy, our budget, but he's not willing to do that under the threat of a default. And so I hope that we will continue to make progress towards that outcome, taking the threat of default off the table and then simultaneously starting these bipartisan, bicameral negotiations about where we go on tax and spending policy.
We've been watching the Treasury Secretary reportedly reaching out to business leaders, asking them to convey a sense of urgency. We just talked to Mary Barr of GM about it a few moments ago. Do you think business leaders have been vocal enough about the risks and what might happen if we approach default?
I think there have been a lot of voices out there that have made clear that a default would be devastating to the economy and should be avoided at all costs, whether it's the folks in the housing industry, folks in the agriculture sector, and elsewhere. I think it's unequivocally the case that a default would be a brutal blow to the economy and would be a completely self-inflicted wound. Look, we've come out of a 2-year-long recovery here where we've seen the fastest economic growth out of any leading economy and are more well-positioned right now than any of our leading competitors. It would be a real reversal to have a default, even a short-term default, which our Council of Economic Advisors has found would immediately cost us hundreds of thousands of jobs and throw economic growth into reverse. It would be completely self-inflicted and unnecessary. And so all we're asking Republicans to do is exactly what they did 3 times under Donald Trump, which is raise the debt ceiling without conditions. And then we can have a conversation about our 2 contrasting visions for tax and spending policy in this country.